Hello, hi everyone. All right, welcome to day 12 of our Project Options Cashflow. All right, it's good to see some of you turning up over here right at the beginning of the session. All right, hi Anthony, hi Mary. Okay, if you're already in the room right now, okay, do us a favor, all right? As usual, just click on the share button for the videos so we are able to get today's topic and reach out to as many people out there as possible, right? Today's topic is going to be a really interesting one, all right? We are going to talk about the topic of selling put options, okay? Now, so a lot of this strategy has been touted about, among option trainers, option mentors, as well as option sellers in general. Okay, there are goods to the strategy, right? Yet we have a lot of people who chooses to adopt the strategy but still end up failing really badly with such a great strategy. So today we're going to cover the myths behind it, all right, and how do you go about utilizing such a great strategy and to do it right so you won't get hurt and benefit from such a great strategy that's available, right, for common investors out there. Okay. All right. Hi, Gafu. Hi, Josephine. Hi, Said. All right. Hi, Diva, as usual. Okay. Hi, Maureen. Good to have you here. Okay. Now, so for those of you who are joining us early into the session, okay, so the usual over here, do us a favor, click on the share buttons, right? And anytime you feel that, I brought a learning point to your time that you have invested with me today on Facebook Live. We are also going on YouTube Live right now. So just do click the like buttons, all right, if you realize I've hit a learning spot for you during the session today, okay? All right, so click on the share buttons and click on the like button if I've managed to teach you something new today, all right, that you never realized before joining the session. Okay, right now, so let's kick off while we wait for the others to join us or more to join us today with our Telegram channel, right? So in our Telegram channel, we are going to go with the stock lingo for today, right? So the stock lingo for today is really triple witching. Okay, so many of you may have heard of this term called triple witching, right? But you don't really understand what it means, okay? Now, so this is just basically where, you have a stock product, all right? Mainly the indexes, all right? All right, that trade as stocks, all right? As well as options, okay? And also what we call index futures. Okay, now, so when the expiry date coincides together over here, which happens 4 times a year, because that's when futures contracts actually expire. Okay, so 4 times a year, all right? On the 3rd Friday of March, June, September, and December, all right, we will witness this event called triple witching. Right now, that means we're seeing the expiry of the futures contract, right, coinciding with the expiry of the options contract. Yeah, okay, all right. And what is going to bring about is, a lot of last minute activities in this particular counter itself, right? So that hence bringing about, what we call the triple witching effect. Okay, now, so that's the stock lingo for today. Okay, now, so hi Ploy again, hi Jacqueline, all right, who are joining us today's session. Okay, now, so likewise, okay, over the next few days is going to get interesting because our topics are really going into cash flow strategies, being an options seller. All right, so we're going to go into the topics of selling options, which is what we do in I Am Possible Investors community, right? And we've done so greatly for the last 7 years by now, right? In fact, our latest track record stands at 449 winning trades out of 451 completed live trades within our community. Yeah, okay, so that puts our success rate records at 99% at the moment. Yeah, okay, now how do we achieve such a great result? Okay, if you want to find out more about this, all right, you could join, our community right now, all right, and, get yourself notified, okay, by going to our website. Okay, so let me bring all of you to the website, okay, where you can, register yourself for Project Options Cashflow or really to get your friends. Okay, if you realize these are all something useful over here, right? You could get your friends who have missed out since day one over here. Who have missed out since day one over here on the Project Options Cashflow all over again from start. Okay, now, so they can join the challenge on our website. Okay, so as they scroll down over here, they could see join our challenge. Okay, or if you simply want to join in, okay, that means to join me, all right, and start trading together with me. That means, you think you pick up these skill sets pretty quick, or you are already within our community, but you just want an opportunity to trade within one whole week live together with me, right? Or, you are belonging to some other options community out there, or even value investing community out there, but you just like to have a taste of how we do things over here, right? And just jump in and trade live with me over one whole week, right? Night after night over here for an hour each night. Okay, that's what you're looking at when we are about to launch Cashflow Madness Week, right? So it's something we've been planning for right here, right? Where we are really looking to generate up to $1,000 in a week, right? Over 6 live trading nights together with me, right? So hence we labeled it Cashflow Madness Week. Right, so if you'd like to jump in, all right, and be the first few who get your hands on it, all right, on the available slots, do put yourself on the wait list. Okay, so once the page is ready and up, all right, you will be the first ones to be notified. Okay, all right, and once the slots are out, all right, then you have to be on the wait list for the next intake there. Okay, all right, now, if you'd like to learn more about how you can sell options on a longer term basis, all right, then we have a really short program over here called the IMP, or I'm Possible Slingshot Masterclass. Okay, you could also put yourself on the wait list for that. Okay, if you are amongst our graduates. Okay, all right. So these are the 2 possible programs that you can look at over here. All right, so they are all found on our website. Okay, all right. Now, so that's all I'm going to talk about over here. So let's get to our topic for today. Okay, all right. Now, so our topic for today, I'm Possible Investors, Project Options Cashflow, which lasts the entire month of June, okay, over a 30 days period, right, where we cover all about options trading, specifically stock options in the US markets, right, and we'll cover all the basic strategies from buying strategies to selling strategies, okay, and then how do you adopt them, some options lingo that, people talk about, is it important for you to know them? Okay, and lastly, some coveted strategies that we apply over in our community, yeah, okay, to really project much higher, greater returns. Okay, now, disclaimer over here, all right, everything that I discussed during the session is really for educational purposes, right? The reason why I'm doing this Project Options Cashflow is really to enrich, right, and also to eradicate any misunderstanding that many people have out there when it comes to options trading. Right, it's really good tool over here, right? Even if you're a retail investor, right? You just need to know what you're doing, just like any financial products out there. Yeah, okay. Now, so if you're going to take on any trades that we're going to discuss during the session, all right, which we will be looking at some today, okay, all right. Now, do make sure you weigh your own risk, right? Do your own judgment and risk analysis before going ahead to do so. Okay, all right. Now, so today, sorry. Sorry. Okay, today's topic over here, right, on day 12 is sell put options. Okay, so today we're going to go into the topic and strategy of sell put options. Okay, and one way I like to bring to everyone's attention, right, in terms of doing it the right way over here, all right, is to label the entire strategy as what we call the opportunist, all right, seller, right, the opportunist seller. Okay, why do I label it this way? All right, as we get into it, right, you will start to understand this further. Okay, now, so I'm going to cover the basics of the strategy, okay, and then how are the different ways in which you can use the strategy, okay, what's the moving parts, the pros and the cons, like we typically do for each strategy of the day, okay, and then how do we go about choosing, all right, the right strike price and expiry over here, yeah, okay. All right. Okay, thank you for giving me your time, because I know at 6 p.m. is a time where, most of you, some of you may already be going back to offices for work right now in the month of June. Okay, to travel back and probably listening to me on your way home just before dinner. Okay, all right, now, so this is a difficult period that we are having for these 2 days, all right, because I have an engagement right after the session, which is during our normal time slot. Okay, but going back next Monday, all right, so next Monday, we are back to our usual time slot at 9 p.m., okay? All right, so 9 p.m. on next Monday again, all right, our usual time slot. Okay, now, so let's get to the topic. So what is put options over here? Okay, so what is put options and what does it do? Okay, all right, now, so let me get to it. Okay, now, so put options over here are really, as we said earlier, the buyer of put options has the right to sell the stock, right? So the buyer, right, has the right to sell the stock. Now, so we as sellers over here, right, the question now, right, that we have to answer is, what do we promise to do? Okay, because as sellers, one of the main things that we get over here is we get paid by our customers. Okay, now, so anytime you go upon the act of selling options or selling anything in general, right? What you're really doing is you're offering a promise, okay, or taking on what we call an obligation, right, to the customer who is paying you the money. Okay, now, so our obligation lies to the buyer of the option, okay, so the buyer of the option, okay, in specifically this discussion today, put options, okay? Now, so if my customer wants the right to sell, okay, if you remember all this, okay, so the buyer of put option gets the right to sell, right? That simply means, right, that my obligation when I sell this particular product today that we're discussing, right, it's really to buy the stock, right? Okay, because options are all still underlying on the stock itself, right? So any promises that I make is specific to an action that I have to carry out on the stock. Okay, now simply means if I decide to sell a put option on Facebook, for example, right, my obligation that I'm taking on, right, to collect this money, okay, it's actually a promise to buy Facebook shares. Okay, all right, so that's the promise I'm making over here. Now, so you realize, okay, that in this transaction of selling put options, when your promise is actually to buy somebody else's share, right, now that means if you're comfortable, right, if you're comfortable buying this particular share that you're looking at, right, all you're trying to do over here is getting someone to pay you upfront, right, before you buy those shares. And what's the perk of this? Okay, well, the perk of this main strategy, which makes people like it a lot, right, is the fact that if you remember, because this is an option, right, now, and you're agreeing to buy somebody else's stock, okay, but in any option, there is this element called the strike price, or simply put, the agreed price. That means this is the agreed price that both parties, right, agree to transact the stock at. That means the buyer of the put option is willing to sell his stock at this strike price. Okay, and me on the other end have accepted the deal, right, to buy and the commitment to buy my customer's stock at the same price. Okay, hence this is what we call an agreed price before we sign on the deal, right, and I go ahead and collect that money from my customer. Okay, right, now just like a like a property transaction, if you go to a property viewing today, right, you like it, the first thing you have to agree upon, all right, is what's the value of the property, what's going to be the transacted price. Okay, and then you put up a deposit and an option is actually signed after that. All right, so it's similar in this manner over here. You have to have that agreed price. Now, so because there's an element of this thing called the strike price or the agreed price, this is where you are in control. All right, remember I said this many times, as a seller, you get to dictate the terms, because if you don't like the terms, you can choose not to sell it. Right, nobody is forcing you to sell anything. All right, so when you run a business, you are the business owner, you decide how you want to do this. Okay, now, so you pick the strike price, you pick what you're happy with, and you go ahead and sell it. But the moment you decide to take this action, you have to make sure, right, that you're happy with the obligation. That's all. All right, okay, you're happy with the obligation. Now, the real benefit of being a put option seller, right, is really this. You're selling someone the commitment to buy his or her shares. Okay, but the best part is there's a time limit to this commitment, right? Hence, we call this the expiry date. So every option contract, if you've been following us so far, right, you realize there are specific expiry dates available, right? Now, which means you can pick from any expiry date that you can find trading in the stock market over here, right? It's up to you to choose. Nobody says which one you have to do, right? It's your comfort zone and what kind of a time horizon you have. Okay, now, so typically, right, people with much smaller accounts, okay, or smaller account capitals, right, they will start off with what we call shorter expiry contracts. Okay, and then you start going into, the likes of Mr. Buffett, who actually sells options and more specifically put options as well. Right, now, what he typically does is he sells longer term contracts. Okay, now, by selling longer term contracts, you allow yourself to get past, right, the typical ups and downs of the market. All right, so all these whipsaws in the market doesn't affect you as much because your commitment is really for the longer term. Right, the expiry date doesn't come right till, for example, a month later, right, or a year later, right, and you can go even as far as 2.5 years later. All right, okay, now so you can imagine, all right, it's all down to you. You are the business owner. You get to plan how you want to run this. Okay, all you need to make sure about is you are happy with the obligation, right, that you're going to commit to buying that stock. And right, I'm not sure about you, but how many of you have ever been in this situation? Okay, for example, let's take I'm in Singapore right now, so let's take the Singapore stock market as an example. Right now, so one of the biggest and the best companies we probably have here, all right, is none other than DBS Bank. Yeah, okay, now, so let's say DBS Bank, all right, is trading for, I don't know what the price is today, to be honest, okay, all right, I'm not afraid because I'm so focused in the US market, right, that I don't look at the Asian markets anymore. Okay, now, I keep to one specific time frame, all right, that allows me to enjoy, the freedom of time from all the other markets around the world. Okay, now, so if you're looking at DBS stocks and let's say, it's trading at 20, 22 today, for example, okay, or heck, let's say 18. Okay, now, if you have been watching DBS shares long enough, okay, and you probably know some of the investors who are good at this, right, they are probably going to shout out at you. If DBS ever gets to $10 a share, you close two eyes and you just buy it. Yeah, okay, now, but there's a problem. The problem is this: if it's trading at 17 or 18 right now, you can't buy it at 10, right? There's no way you can buy it at 10. Yeah, okay, but with the fact of selling put options, which you realize what I've discussed over here, and if you caught it, right, you realize that now you could sell something, right, that obliges you to buy the stock, right? But you get to choose what stock and what price you want to buy it at, right? So if there is ever an option in the Singapore stock market for this particular stock called DBS, right, you could commit yourself to buying DBS shares, right, at $10, right, if there was such a strike available, right? Okay, now, how much can you get paid for that? That's a different question, right? But you could effectively sell a $10 put option on DBS, right, which then commits you to buying DBS stock at only $10. Because, right, if it doesn't go to 10, right, your customer will not let go that share. If it's 17, right, why would your customer sell you a stock at 10 for something that's worth 17, right? Even if it drops all the way to 11, right, he's still not going to sell you something that's worth 11 at $10. It just doesn't make sense, right? So in this event, what he's going to do is he's just going to let the option expire, right? He's not going to claim on it. Now, that's where you start to profit, right? Because we talk about the element of this potential obligation. Okay, now, so potential obligation simply means, right, that yes, you made a promise, right? But if your customer doesn't do anything, right, then you got paid to do absolutely nothing. Yeah, okay. Now, so I hope I elaborated that part enough, right? It's clear enough for those of you who are joining us. Now, so first, the best part of the entire deal is that you get to collect money up front. Okay, you get to collect money up front doing this. Okay, second, right, you do this when you have what we call a sideways, right, and a slightly bearish, okay, all right, this can only be slightly, okay, but I realize this is more or less a typo error that I didn't correct upon. Okay, let me do it now, okay, to avoid confusion, okay, all right, give me a minute. Let me do it now to make sure I don't confuse all of you. All right, great. Now, so you do this when you have what we call a sideways, okay, a sideways or a bullish view to the stock. Okay, now the reason why is because, right, most people, right, when they sell put options, okay, they really want what we call simply the premiums or the cash upfront, right? Most of them do not want to own that stock. All right, okay, now that's something we do a lot over here, right? And I realize a lot of others actually do that too. There's nothing wrong with that, okay? But the problem is, right, if you are asked to own those stocks, okay, right now, great. Don't misunderstand me. If you have the capital, all right, if you have the capital to own those stocks, right, there's so many great stocks out there that you can own for the long run, right? Especially when you get to determine your own price that you buy it in at. Okay, but there are so many of us, right, especially those that are starting out right now, okay, that simply lacks the capital, right, to do enough of this. Okay, now, for example, if you have like a capital that's starting out at 2,000 US dollars, right? Now, if you're selling one contract, okay, of an Intel put option, right? And let's say you sell a one contract $40 Intel put option, right? Your commitment is to actually buy 100 shares of Intel at $40. Okay, and you realize that commitment is already going to cost you 4,000 US dollars, which simply means that your $2,000 isn't enough. Yeah, okay, now, so you realize, right, that this, while it's a great strategy, right, it's also a game that we call for the people who are affluent, the people who have the money and the resources. Yeah, okay, no, without a doubt, it's one of the best cash flow generating strategies out there. Okay, but if you don't do it right, okay, all right, now, it's dangerous. But if you do it right, the biggest problem is it requires too much capital, right, in the event that you're wrong. Yeah, okay, all right, now, so sideways or bullish buyer's view. Okay, now, next one over here. Okay, again, because we're sellers, so our first action is actually to get paid, right? So before we start looking at any loss over here, right, there is what we call the break-even point. Okay, the break-even point. Okay, all right, now, is everyone clear and following so far? All right, if you're following and you're pretty clear about concepts, can you just leave a comment over here, right, and type in clear, right, so I know you're following along fine. All right, just leave a comment clear over here, all right, so I know all of you are following along fine, yeah, all right. Okay, now if you're joining us on this live stream over Facebook right now, okay, all right, could you do, could you help us share as much of this information so many people can benefit from it, all right, by clicking on the share button for the live video, okay, all right. All right, thanks, Melanie. All right, great. Okay, Diva, great. Okay, now, good. Okay, so since most of you are typing in right now and you're clear, let's move along. All right, now, so let's say we're looking at this particular stock today. Okay, let's say we're looking at Bank of America. Right now, so it seems like Bank of America had their issues, right, with the way the bank was being run. Right, they had some fundamental issues, but they have seemed to have sorted out. All right, and now they seem to be one of the best and most promising bank in the US. Okay, for example, so if you buy that story, right, okay, and you see that today the stock price is trading at $22.95. Okay, there are a few things you can do over here. Right now, if you decide to be aggressive, okay, that means you're very aggressive. Okay, you don't mind buying the stock at today's price. Okay, that means you don't mind buying the stock at this price. You feel that it's fairly valued. Okay, or in fact, you already feel that it's cheap. Okay, one thing you could do is to pick the 23 strike put option. All right, as you can see over here, right, you can pick the 23 strike put option. All right, and actually choose to sell this contract. Okay, which is going to pay you 131. All right, 131. Okay, now, which means, okay, when you sell this put option, it simply means, all right, that if BAC shares were to actually go up, okay, all right, and it goes up to, just $24. Okay, so this is for 19 June, right, which is around about 30 days time, about a month, all right, when I quoted this example. So in the next 30 days, if BAC were to just go up by $1, right, now what's going to happen is, right, you as the seller, right, are going to be able to keep the 131. Right, now what you sell it for, that means this 131 comes to you on day one. Right, you get paid this amount the moment you click the sell button. Right, and your orders are accepted. Right, now, and the best part to it is when you pocket this amount, right, you don't have to return it. Right, yes, you took on an obligation to buy the stock if you need to, right, but the premiums that you get, right, you are not required to return any part of it. Right, just like insurance policies, you can claim on the policy, right, but the company is not going to pay you back the premiums, right, that you have invested. Right, so it's pretty much the same concept over here. Yeah, okay, now, So if BAC was to go up to 24, right, what's going to happen is your customer, right, is not going to sell you the stock at 23, right? The stock price is 24. So which means he or she has a stock that is worth $24 today. There's no way that he's going to sell it to you for 23. It just doesn't make sense. Yeah, okay, all right. Now, so what's going to happen is this option then is going to expire, right? There's going to be no claims on it, right? Which means it expires when its time's up, right? And the value of it becomes effectively zero, right? So you as the seller stand to make the 131 that you have pocketed from day one. Okay, now, so let's talk about break even. So we basically said that there is a point which we call break even before losses. Okay, now, so break even is really where, right, you get the strike price, okay, minus the premium paid. Okay, because you're committing to buying somebody else's share. All right, but before you have to do that, right, you realize that you have already pocketed 131 upfront by selling the put option. So which means that your break-even cost or the cost of the share is actually not really 23, right? But it's 23 minus how much you're getting up front, which is 131. Yeah, okay. So the break-even price, or you can think of it as the cost of your purchase of the share, is actually 21.69. Okay, 21.69. Okay, all right. Now, so let's look at a diagram which will make it easier for you to understand. Now, so we said that this was pretty aggressive because the stock is right here, okay? And you realize that the put option line that you're selling, all right, is actually currently above the stock price, okay? Currently above the stock price, okay? Now, so which means that if you don't want your customer to make a claim, right? That means if you don't want your customer to make a claim, the stock actually has to go up above your line, okay? Because anywhere below the line, right, the customer is going to initiate the claim, right? And another fact, right, any options that expires with what we call a claim value to it, right? Now, a claim value simply means that the stock price is below the put option line in this case, okay? Now, if any option expires with a claim value attached to it, right, the exchange or the options exchange is going to automatically exercise that option. Okay, now, so in your case, it simply means, right, if the stock stays below the put option that you're selling, right, whether the customer exchanges or exercises or not, the exchange is still going to do it at the end. Yeah, okay, right. So it's basically, surely going to happen, right? So if you don't want that to happen, the only way is if the stock goes above, right, your commitment line over here, which I'm going to commonly label it as. Okay. Now, so our break-even price is 21.69, right? Which simply means, yes, the stock can still go down, right? But as long as it doesn't go below, right, 21.69, right, we are still going to end up making some profits on it. Okay, some form of a profit on it. Yeah, okay. Now, anything above that is, of course, profits, okay? And, all right, anything below that, right, it's where, we'll be looking at losses there, right? So anything below that, right, it's going to be losses. Okay, now, so effectively, right, from where the stock is right now, okay, to our break-even point, okay, that's our room or what we call the margin for error. Okay, so anywhere from 23 put, which is our strike price, all the way down to 21.69, okay, the stock can trade within this area, right, and will still not lose any money, right, on expiry date. Okay, all right. Now, let's discuss the other way. Right now, the other way over here is the opportunist, right, which I've labeled the strategy, right? So in this strategy over here, you should always try to adopt what we call the opportunistic seller. Right now, that is where, right, you first find a stock with a story, okay, that you feel, it's already undervalued, it's selling for the cheap, all right, its potential is really big, all right. So you basically expect that the stock price should go up, right? Now, so once you expect the stock price should go up, right, what you can do is really to pick, all right, a 21 put option, all right, and sell it. So effectively, all right, the stock is trading about $23 today, right? But you're selling a commitment, right, to buying the stock at 21. All right, so you realize what we're doing now? The stock is at 23, right? But you're selling someone your promise, your commitment to buy that stock, not at today's price, Okay, all right, but only at a lower price of $21. Now, in a simple term, it just means if the stock doesn't go below 21, right, your customer is not going to do anything, right? And if it goes below 21, right now you already feel that the price is cheap. So if I ask you to buy at 21, technically you're buying it for even cheaper, right? So, if you can operate under such a condition, then, it's still a good investment after all, right? You're just doing, one additional step of getting paid before exercising the commitment of buying the stock, right? And you didn't need to buy the stock at today's price. You're buying it at an undervalued price. Yeah, okay. So this is similar to, what property investors would do, where they go out there, they hunt for a great property, right? And they're always looking for that deal, right, where such a great property is selling below the bank's valuation. Yeah, okay. Now, so by selling put options, we can start achieving the same idea, right, and making money in the same particular way. Yeah, okay. Now, so for this option, we'll get paid 56 cents, which is effectively $56 for each option contract. Okay, so you're going to get paid $56 upfront, right, for a promise to buy 100 shares of BAC shares. Yeah, okay. Now, so from a diagram standpoint, this is how it looks. So the stock right now, it's here, which is $22.95. Okay, all right, and you're committing to buying the stock only at 21. Okay, by selling the 21 put option. Okay, all right, now, so this means now that our break-even point, right, it's actually at 20.44, right, 20.44, which is this line where it is right now, okay, less the premiums that we have collected up front, which is 56 cents, okay, 56 cents. Now, so anything above 20.44, all right, would mean that you still end up with a profit. Yeah, right, you still end up with a profit. Okay, now, and look, the stock is trading at $22.95 right now. Yeah, okay, now, what you have right now over here, right, is this entire range for what we call a buffer for error, okay, a margin for error. Okay, now, so that's why option sellers love selling put options, right? You can be wrong, right? You can be wrong, and you can still end up profiting from it without any liabilities and any commitments. Okay, now, so in this whole event over here, you realize one thing, right? The only thing that can hurt you, right, and possibly kill you to a certain extent is if the market collapses, right? So you're probably looking at, one-off events like what we saw yesterday. Yeah, okay, but you realize for one-off events like what happened yesterday, right, the thing that you should be doing is going out there and start shopping. Yeah, okay, all right. Of course, if you manage your capital right, if you manage your risk right, then today you're going on what we call a full-on shopping mode, right? But if you have been too aggressive, right, that means you have been selling too much before such an event, then it's an equivalent of, there's a great Singapore sale right now, but, you have maxed out on all your credit limits, right? So, you should go shopping, you should, because you get all the best deals, but you simply can't, right? You can't because you don't have the capital to do so, right? So selling options is really pretty much, right, how good are you at risk management and how good are you at capital management, right? If you're always doing it within your means, right, and doing it in a way which you can afford it, then this is a great long-term strategy, right? It's a great long-term strategy that can beat, a lot of simple stock investing, right, in a very simple approach, okay, where you don't need to do too much analysis, right, and actually outdo a lot of portfolio performances. Yeah, okay. Now, so let's quickly go to the diagram con, right? Now, so diagram con works this way. We start off with a profit over here, right? Now, and if the stock starts going down, right, you'll start eating into our profits, which is the premium that we collect, right? And then you'll hit break-even point, okay? And after that, if the stock still goes down some more, right, and then what we're looking at right now are then losses. Okay, now if you're willing to own the stocks, that means you're willing to commit to buying the stocks, right, then you are looking at what we call paper losses, right? But if you don't have the capital, right, and the broker initiates what we call a margin call on your account, right, if you're not acting on it, the brokers will ultimately sell the stocks away, right? And that's when it becomes a realized loss. Yeah, okay, because if you own the stock, you could always say, okay, I can wait for it to rebound, right, and then I don't have to lose any money. Yeah, all right, which is true, right? Because if they are good stocks, right, most people, when they make losses on great stocks, they simply just buy and hold. right? Now, as much as you want to tout on it, as much as you want to talk about it, right? But there are very few of us, right, who would end up buying DBS stock today, right? And if you see yourself losing money tomorrow, right, you would actually be, hard-hearted enough or, calm enough to actually initiate a cut loss on the position, right? And, take your losses, right? Now, too many people just can't do that, right? Hence, that's why, they adopt what we call the buy and hold strategy, right? Because one of the reasons perhaps that they would choose DBS compared to any other stock, right, is because they have the objective that if I do this, I'm going to make money, right? Okay, no matter what, I'm going to make money. It's just a matter of when, right? Now, so if they are wrong initially, they are always willing to wait for it to go up. Much like property investors, right? If they buy within their means, right? If tomorrow, I'm touching wood right now, if tomorrow the property cycle collapses, all right, and prices were to go down, right, as long as they can keep up with their payments, right, they're more than happy to wait for the property prices to rebound, right, before they think about selling any of them, right? So, pretty similar concepts. It's not difficult to grasp actually, yeah, okay? Now, but of course, we really want the stock price to just sit where we started the entire trade or to actually start going up from there, okay? So this is what we mean by sideways, right, to bullish biasness, okay? All right. Now, so how do you use the strategy? You should be bullish on the stock, whether it's near-term, short-term, or long-term, you should be bullish, okay? So it's more practical on what we call hot stocks or growth stocks, okay? But we could also add in value stocks over here, all right? Value stocks, okay? Now, next, then you'll be looking at all bullish factors, okay? Which means it could be event-driven, it could be product launches, all right? Which was very popular with Apple back then for, many of their product launches, okay? It could be breakout patterns, it could be bullish flags, it could be ascending triangles, it could be cup and handles, it could be oversold signals cutting back up, right? It could be divergent signals on the bottom, all right? Okay, that means probably your higher low, all right? Yes, correct. Higher lows over here that you see, right? Which means there's a change of trend, right? Something like that. Okay, you basically want the tune to be flat or biased on the bullish upside. Yeah. So you sell put options when you're bullish, okay, but you have doubts on the timing. Okay, you have doubts on the timing because if you're very firm on the timing, then you're probably better off, served by buying an outright call option instead. Yeah. Okay. If you're so clear that it's going to go up, it's going to do a sharp rise, then it probably makes a lot more sense buying an outright call option. Yeah, okay? Now, so selling put option gives you the benefit of the doubt in case you're wrong, okay? But you sacrifice the profit potential because there's a limited profit that you can make, right? Versus buying the call option, okay? So that's the main difference. Now, moving parts, which is very similar, right? What's your expectations, right? So that will lead to how you choose the strike price. Okay, all right. Now, how long do you think it's going to happen? This will lead to how you choose the expiry date. Okay, all right. And then how much do you want to allocate? Which means, right, what kind of a trading size are you going to do? All right, 1 contract, 2 contracts, 3 contracts. Yeah, okay. So pros and cons. Okay, you can be wrong and still make money. Yeah, we talked about this quite a lot over here. Right. Next, you get the benefit of time decay. Okay. Third, you get a margin for error. Okay. And lastly, you get the idea of leverage. Okay, now why do I say leverage? Okay, now you may not be doing this, okay, and this may not be the best way to do it as well. But selling put options over here, right? All the broker wants from you, right, as a setup for margin is really 20%. Okay, this is just a ballpark, but it's usually right about there. Okay, right? It's usually 20% of the sell put strike. So if you're selling we were selling the $21 put option, right? Okay, if you're selling a $21 put option over here, right? For example, on BAC, and you're selling just 1 contract, okay, your initial outlay, your initial investment to sell such a put option is actually only gonna be $420. Okay, $420, which now becomes affordable, and many people can do that. But at the same time, you realize this is where leverage may be good, but leverage can also kill. Yeah, okay, because brokers are going to ask you for the smallest amount to allow you to do that. Okay, but when there are losses and losses start to accumulate, right, the brokers reserve every right, right, to demand up to 100% of your commitment, okay, for that trade. Yeah, okay, so they can start off at 20%, but it could go all the way to 100% if they want to. Okay, so anywhere along those lines, if you don't have the capital inside of your account to sustain that position, right, then you are in a situation that we call a margin call, right, which simply means you ran out of money, right? Now, so if you don't take any actions, or for example, to put more money in the account, right, then the brokers are simply going to cut your positions. Okay, the brokers are not going to take any risk on you as a customer, right? They're just going to cut the positions because they're in the brokerage business to facilitate trades and earn money on commissions, right? Not to take customers' risk over here. Yeah, right now. So what's the cons? The cons is there are technically unlimited losses because there are many people, right, who go out there, right, and simply pick a stock and start selling put options blindly, right? Because you must understand, in a bullish market, right, many people can blindly sell put options, right, and keep making a lot of money, right? But it is when the music runs out, okay, when the music runs out, where a lot of them are actually not ready to face the consequences. Yeah, okay, so there is at least a certain amount of work that should be done, all right, when you adopt such a strategy. At least know what stocks you're selling, right? At least you know what are the fundamental values behind those stocks. Are you comfortable, right, with owning those stocks at whatever prices that you're committed, right? So these are some of the basics over here to doing it right. Okay, now next, bankruptcy risk, right? So if you want to avoid this, then you better make sure you sell it on companies, right, that even you yourself cannot imagine that bankruptcy will ever happen on this company. Yeah, okay, that will avoid you or absolve you from such a risk. Yeah, okay. Now, so there are risks. The thing is, there are a lot of risks, right, when it comes to selling options. I don't deny that. But there are also many of these risks that can be controlled, right? It can be controlled with certain guidelines, certain criteria that you can set before you actually go into the markets and do this, right? Now, this is something that, I talk a lot about, right? And I share a lot about with my students in the community, right? When I teach them how to do this particular strategy, which is really, really great, right? But more importantly, how do you do it right? Okay, now, so you realize there's a lot of goodness in this strategy, right? But you are able to benefit, maximizing the benefit from it only if you know how to do it right. Yeah, okay, only if you know how to do it right. Yeah, okay, so understand that. Next, there is exponential move risk. All right, so this exponential move risk is really on the downside. Yeah, okay, because on the downside over here, right now it could go down. Yeah, okay, and it could go down really fast. For example, like Hertz. Today it's fine, tomorrow it's bankrupt. Yeah, okay, you don't really want to go into those companies over here. Yeah, okay. Now, next over here, breakout move risk, right? Which means breakout move on the downside. Okay, so you want to avoid those risky scenarios as well. Okay, all right, now, so I'm pretty much done, okay, but instead of going through, these kind of trade on the mill, differences over here, I want to take you into real market opportunities and real examples over here, okay, all right, I think that's more practical and that's more adaptable in current market situations. Okay, now, so how many of you are ready? Okay, how many of you are ready to find out what are some of the possible deals, right, that you can shop on and shop upon, right, in today's market's terms? Right, if you're ready right now, type ready in the comments. Okay, ready in the comments. Okay, right, leave a ready in the comment. Okay, and we got 20 yesterday. Okay, we got 20 yesterday. So let's improve every day. Okay, together. Okay, we'll do this together. Let's improve every day. All right, I want to see ready from 25 of you. Okay, all right. So every day I'm going to increase this number a little bit more. Okay, 25 of you. Okay, if I get 25 readies, right, in the comment section, all right, I promise you, I'll show you at least 2 examples, okay, of some great trades that you could be taking over here. Okay, 25. Okay, go ahead. I'm going to prepare myself for those deals because I believe all of you will be able to break my expectations over here. Okay, but while I do that, okay, you guys continue. Okay, to leave your comments. Okay, all right, please continue to leave your comments. Okay, all right, remember 25. Winkai, you're seeing it from another channel. So we have multiple channels where we have double the amounts and more than double the amounts right now. Okay, now so definitely it's doable. Okay, Winkai, I'm not here to to make sure I don't get to share with all of you. Okay, I just want to make sure everyone is listening. all right, and basically being attentive over here. All right. Okay. I don't really want you to be wasting your time by just leaving it on, but not really paying attention, because there are many tips, and golden nuggets that you can pick out if you're really paying attention over here. Right. Okay. So many of you may not even be my students, but we really want to show all of you what options can really do and how great they are. Okay. Now, so let me consolidate. All right. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. All right, keep going, keep going. All right, keep going, everyone. All right, okay, keep going. I've got 2 already. Okay, I've got 2 on my list. All right, ready to share. Okay, in our very quick session today. Okay, keep going. All right, ready. 18. All right, 18, 19. All right, keep going. We need another 6 more of you. All right, 6 more of you. Let's go. Okay, 6 more of you. All right, if you'd like me to share this as well, all right, on some, money-making opportunities next, okay, but please weigh your own risk before you do any of these trades, okay? All right, but if you're ready, all right, type ready, and then also click on the like buttons on the video, all right? Okay, make sure you like the videos, all right? So, I know what I share with you is very useful, and benefits you as well. Okay, all right, yes, we're almost there. 20, 21. Okay, all right, 4 more of you. Let's go. 22. All right, okay, 22. All right, come on. Let's go. Shady, does that count as 3 or does that count as 1? All right, okay, now. I'll cut to the chase, all right? Shady, I'll take it as 3, okay? All right, you helped everyone over here. Okay, now, so let's do this. So let me swap it out, all right? Let me go to my brokerage platform, and let's do this. Okay, now, so market had what we call one of the big sell-off again yesterday, all right? Something that I've been mentioning and repeating it over and over again. I can't say enough, okay, all right? While many of you are blinded by the bullishness, while many of you are lapping up all the trades out there, right, you might be ignoring the risk of this potential correction in the market when there is something that people do not like anymore. Right, because when everybody's on one side of the place, right, and it shouts fire after that, all right, everybody's going to rush for the exit, right? And yesterday, you clearly saw that happening over here, right? You clearly saw that happening. Now, so yesterday was a day where we had what we call correlated movements. Yeah, okay, some of them will call it, either a correction move or, a move with vindication over here, but I'll just call it what I call a correlated movement, right? Now, so when you have a correlated movement, right, it actually signals that the current trend has a crack to it, right? Okay, because if it is not correlated, okay, that means it may just be a correction move or like what we call a resting, right? But when we have an entirely correlated move in the market, right, that means the current trend is showing a sign of crack over here, right? Now, so when the current market shows a sign of crack, okay, this is not the time to be going long in the markets without ample protection, without sufficient protection, okay, right? But it also doesn't mean that there are no great deals to be found, right? Now, what do I mean? It doesn't mean there's no great deals to be found. Okay, now have a look at this. Okay, if you believe, right, that despite all the crises that we're facing right now, okay, that one particular industry should remain relatively unharmed, okay, right? They may not do too well, but they will still remain relatively unharmed, okay, unharmed. Okay, now that will probably be the pharmaceutical, industry itself. Okay, now if we're looking at Pfizer right now on my screen, okay, Pfizer is definitely one of the biggest pharmaceutical companies that we'll probably see out there, right? They're probably most famously known for their blue pill over here, right? But let's leave that aside for now. Okay, let's look at the money-making potential instead. Okay, now, so what can you deduce from this screen right now? Okay, now, one thing you could deduce is this. In March, right, when the market thoroughly sold off, right, it brought Pfizer to a low of around $28, okay, right? So if the market crashes, right, it could bring Pfizer to as low as $28. Now, So if it were me right now, okay, and if I'm in my shopping mode, right? If I'm in my shopping mode, right, I may see it this way, right? If I could get to buy Pfizer at $28, right, it ain't looking too bad as an opportunity. It doesn't look too bad as a deal, right? So the question that I need to answer now is how much can I get paid to offer people such a promise, right? Because you realize when I say when you sell put options, you're simply offering a promise to a customer, right, of buying their stock, okay? But you get to choose how much you want to buy the stock because you get to choose the strike price. So if I want to buy the stock at 28, my job now is to go out there and hunt down a $28 put option. Yeah, okay, now, so let's take a look, all right? Let's take a look. If you're happy with that, okay, now, I could go as short as 7 days, which is next Friday, okay? And I wanted a 28, okay? But you could see, for something that is so short in duration, nobody is going to pay you any amount for such a deal because it's ridiculous, all right? Okay, but, right, with the emphasis on time, something can happen, right? So, for example, right, if I do this for 35 days instead, all right, it seems not available at the moment, but you could get something for 29. All right, so we're nearly there, right? We're nearly there, right? Now, it means that if I'm willing to go up to about 100 days from today, 100 days from today, right, I could sell the 28 put, right? And you could see we could pocket about 61 somewhere between 61 to 75 cents for this put option, all right? 61 to 75 cents for this put option. If we were to take just the last traded price, it shows us a mark price of 68 cents. Now, it simply means I could offer someone the commitment to buy Pfizer stocks, right, for the next 100 days, okay, if it happens, all right, at $28, all right, and I could get paid upfront $68 right now for 100 shares. Yeah, okay, now, and if it doesn't happen, I get to make $68 scot-free, right, without any liability, without any commitments. Right now, so if I'm comfortable owning Pfizer as a long-term investor, right, what's the qualms about, right, being able to buy a great company that I like, right, at such a bargain value price, okay, if it ever gets there again, right, and if it doesn't, I still get paid. So you realize selling put options is a situation where if you do everything right, heads, I win, right, tails, technically I still win, right, if I'm happy with the risk. All right, okay, now, is this great so far? Right, now, if this is great for some of you or most of you, can you type great in the comments? Okay, all right, type great in the comments. Okay, now, if you want to hear my next one over here as well, make sure you type great. Okay, make sure you type great. Okay, all right, now, make sure you type great as well. Okay, now, so I also want to do something new. I want to try something new as well. Okay, right now, I'm going to consolidate. I'm going to go over to Facebook and have a look right now. Okay, if I can get 10 of you, okay, all right, 10 of you or more, right, who are joining us right now, to click the share button, right, to click the share button on the video and get it out, all right, okay, I will give you a second stock, all right, and trust me, this second stock is even more ridiculous, right, it's even more ridiculous, all right, okay, now, if every one of you have the resources, trust me, it's a no-brainer and you will do it, okay, it's a no-brainer and you will do it, okay, all right, I promise you that, okay, all right, now, so my students know whenever I make such a statement over here that is really going to be a great deal. Okay, all right, now, so do this for me. All right, I'm going to go over to Facebook and just have a quick look. All right, just make sure you click on the share buttons. All right, and when we have 10 of you sharing those videos out there, all right, okay, I promise you I will start sharing the second stock that I want to talk about today. Okay, all right. Okay, 10 of you, okay, all right, share buttons, 10 of you, okay? So it's all on the Facebook, wherever you're accessing it from, be it on my profile or be it on, my Facebook page over here, all right? All I need you to do is to click on the share buttons for the video, right? And once I see 10 of you have done so, right, I will share with you the second opportunity, right, which I found is truly ridiculous in the market right now, okay, after yesterday's night market sell-off. Okay, or we could call it a great market sale yesterday night. Okay. All right, great, great, great. Come on, keep it up, everyone. All right, we're nearly there. All right, remember 10, okay, 10. Right now, one of the reasons why I want to get all of you to share this out today as well, right, is because you realize, okay, I really like this strategy which I'm talking about and sharing about today, right? And I really feel that a lot of people or a lot more people could benefit from knowing this that I'm talking about, right? So I really want, with your help, right, to be able to get maximum reach over here, right? So most people will be able to benefit knowing about such a strategy. Yeah, okay, all right. So do this. Let's work together over here, right? Let's get 10. All right, shares and more going out for this. Okay, all right, 10 or more. All right. Okay, great. I see it moving over here. Very, very good. Okay, very good. Okay, so let me consolidate them. All right, great. I see 10. Okay, all right. Now, some of you may not see 10 because we are accessing the video from 2 different profiles. All right, so what I'm doing over here is I'm totaling them up. Okay, all right, great. Thank you very much. Okay, now, so in exchange over here, this is my promise. Okay, ready? Right now, so a no-brainer stock. So what do we call a no-brainer stock? Okay, a no-brainer stock is simply a stock, right, which we know operates by the best investor in the world out there. Right? Many people feel that he's over the hill, right? But you can't doubt the amount of work that he's done, the great work that he's done, right, so far until today. Okay, now that's of course none other than Berkshire Hathaway. All right, now, so what happened in yesterday's market was in the correction, or the correlated sell-off, right? We got a drop in one day for Berkshire Hathaway for about $18. Right? It brought Berkshire Hathaway down to the tune of 10%. Right, it brought Berkshire Hathaway down 10%, right, in the markets. Yeah, okay, all right. Now, imagine that, okay, imagine that. Now, and this is the best part, right? You realize that, in this crisis period, somewhere in middle of March over here, the lowest point of Berkshire Hathaway, probably after they announced their earnings or something like that, right, it hit a low of 160, right? It hit a low of 160. Now, so if I let you have an opportunity to buy Berkshire Hathaway shares at 160 again, right? Do you think that's a great bargain? All right, okay, because at 160, that's another 10% discount, right, from where the stock price is today. Yeah, okay, it's fallen by 10%, right? But you're committing to buying the stock, right, only another 10% below. Right? So effectively, you're getting a bargain of 20% below market valuation, right? If this was a property transaction. Yeah, okay. Now, so let's go and hunt down this deal and let's see how we can get paid. All right, BRK, B shares, okay? All right, we're talking about the B shares, okay? B shares. Okay, all right, take a look, everyone, take a look. For the same 100 days over here, for the same 100 days, right? For Berkshire Hathaway at 160, right, I could get paid up to $500 for one contract. $500 for one option contract over here. All right, okay, now, so that's how great this opportunity is over here. As you can see for yourself, there's premiums at stake, right? There's money to be made, right? It's all down to, are you comfortable with such a stock? Are you comfortable with the price? Okay, are you sure that it's probably not going to reach there over the next 100 days, even if you have further market sell-off, right? If you believe that's your view, that's your point over here, this is definitely one deal you could look at, right now over here. Yeah, okay, now, so this is really what I want to share over here, okay? And, like I said, this is really one of the deals over here that many, has thrown out there. I've just shared with you 2 over here. Okay, now, if you are not amongst our community, and you'd like to find out more about how we do it over here, right? So do make sure you follow my Facebook page if you have not done so, right? Or go over to our website, okay, and click on the links that we have available there, right? And make sure you get on our list, okay, of our next available programs, okay? And also, if you have not done so, okay, if you have not done so far, right, do make sure you scan our QR codes and make sure you are in our Telegram group, right? So we can alert you, right, once we have any events, ongoing over here. So you can join and be part of our great community. Okay, right now, any questions from those of you who are attending with us right now? Okay, if you do have any questions, right, can you leave your comments? All right, leave the questions in a comment. All right, I have time to address probably a couple of questions before I end off tonight's session. Okay, all right, questions. Questions from anyone? Seems like we're pretty good today. All right, no questions. Everybody's too busy analyzing what I just said, all right, and all the deals that I just mentioned. All right, trust me, there's so many more, so many more. All right, so many more. All right, okay. Okay, great, Maureen. Let's answer this question over here. First, for margin calls, usually how long it takes before the broker takes any action. Okay, all right. Now, first over here, you should not be doing this particular strategy, all right, in a way which you cannot afford to do so. All right, now one, which means, right, if you're going to get a margin call, right, if something should happen, right, that means you're doing this all wrong already. Okay, all wrong already. Okay, right now, but also at the same time, if I were to ask you to put up 100% cash, okay, all right, which, you know, this is what we call the cash secured puts over here, right? Now, I'm not saying that it's not great, okay, but doing cash secured puts, right, is one of the sins over here, all right, when it comes to capital management. Yeah, okay, because you could do a lot more with that capital, right, that you're leaving aside on the table. Right now, think of it this way. Okay, right now, I know many of you are probably shouting out right now, no, Terence is wrong. No, what I'm trying to say is this. Doing a cash secured put, right? Doing a cash secured put is as good, right? Is as good as, right, a property investor, right, who's going to go out there and acquire properties paying full cash upfront. Right? Now, that doesn't sound too smart idea, right? Then why would you do that with stocks? Yeah, okay, now that's always the question that I pop not only to my students, right, but to students or people that I just meet the very first time as well, right? Why should you do this? Why should you learn how to do this the right way, right? It's because it makes a lot more sense, right? Why do people go out there, right, invest all this money and learn how to invest in properties? You know how to do it, right? But you want to know what's the numbers behind it. What's the mathematical formulas behind it? What kind of loans can I take? How much loans can I take, right? Such that even if the property sector collapses, I'm still fine. Yeah, right? Because the only thing that can wreck your investment portfolio is if you run out of money. Yeah, okay? All right, now, but if you don't, that means you are effectively building something that can last the long run. All right, now, so this is specifically what we do in our community because we stress a lot on how much allocation you should put for each option that you're selling, right? Such that you start off, right, without the need to put up 100% cash upfront, yet you know that you're fully capable, all right, of not triggering any margin calls from the broker. Yeah, okay. Now, but just to make sure I answer your question as well, Maureen, okay, margin calls are typically acted by the broker, all right, on whatever they like. Right now, what do I mean when I say that? Okay, now, because for every brokerage, okay, this is what I understand directly from the horse's mouth, okay? Right now, for every brokerage, they have a department called the risk department, right? And whether you believe it or not, the risk department is the biggest in the entire company, right? Which means in terms of power, right, they have the biggest power, right? If they say yes, right, even the CEO has no right to say no. That means if they trigger, right, and say that this account's position needs to be liquidated, right, there is no argument, right? It has to go, right? And they do not need to answer to anyone, right? And actually, it makes a lot of sense because the risk management department, right, is there to protect the entire company. Yeah, right. So nobody will challenge their judgment over here, right? If they say yes, it's risky, we're cutting it, right? It goes, right? So it is all on the onus of, right, what are their guidelines, which nobody really knows, all right, and which account happens to be in their view right now, right? Because for a sell-off like yesterday, right, whether you like to admit it or not, but we'll probably have many accounts that are triggering margin calls, right? Now, so how do they hierarchy it, right? They probably hierarchy it from, what the computer system flags to them, right? And then you'll start to analyze which account possesses the higher risk, right, out of the entire margin call issues, right? So they prioritize those accounts, right? And then they'll start going down the entire list. Okay, now, so if you happen to be the lowest risk among the lot, right, you have the opportunity where the market may rebound and, your margin call is elevated, right? Who knows, right? But you're basically given more time than the person, right, who have really over leveraged himself. Okay, simple example. If you have $5,000 in your account, right, and when the stock gets delivered to you, right, for example, right, and your margin call on $50,000, okay, because of the cost of the share, for example, that means your margin call is over 10 times of what your account capital is. Right now, can you see that sounds pretty risky? Right? Okay, it sounds pretty risky. So you're probably going to be flagged as one of the first few with the brokerage system over here. Right? Where else, if you have a $5,000 capital, right, but your account is triggering a margin call of $1,000, you're probably prioritized much lower over here. Right? So it really depends on what's the extent of the margin call that you're facing. Right? So, how quick they take upon the action is really entirely dependent on how severe the margin call is. Okay, is that clear, Maureen? Okay, I think I'm pretty detailed over there in the explanation. All right, okay. Richard, sell put spread, which is better? Judge for yourself, right? Today I'm talking about put options. Today I talk about the different perspective of it, all the different deals that comes with it. Tomorrow, right? Not tomorrow, Monday, right? Monday we'll look into sell put spreads, which is our next strategy on the agenda, right? So I'll cover the same perspective and aspects of it, right? And then after that, you form your own opinion, right? Okay, you form your own opinion, all right? And you decide which one you like better as a strategy and as an approach. Okay, right? Now, Richard, right? If you cap your put spreads on SPY, right, you should be making good profits today, right? You could probably close them today as well, right? Richard, are you still holding those trades? Right? If you are, leave a comment and let me know, okay? Right? So I'll address next question for Josephine over here. Now, deposit for this counter, if we sell the 160, it's going to be 3,002, right? Yes. The initial margin that the broker will want is 3,002, Josephine, right? Okay, but remember, right, this might not be enough, right, if Berkshire Hathaway shares were to go even lower, right? The broker reserves every right, okay, to start calling more if they want to or they feel a need to. Yeah, okay, right now. Also, do understand that, okay, While I state a ballpark figure of 20%, right, the broker hierarchies, right, how much is the margin requirements for different stock as well. Okay, if they deem a stock is low beta, which means lowly correlated with the index, okay, now, or what we call safe havens, okay, they may actually ask as little as just a 10% deposit upfront, right? It's the broker's discretion, right? They actually have a list of stating, what stocks, what kind of margin, but it's too much effort. It's too much effort to go through them one by one. Yeah, okay, now, so just as a ballpark, typically most of them are at 20%. Yeah, of course, you'll probably have the higher risk sector, which are mostly, oil stocks right now, right? They may start off initially with 50% margin, right? It has ever happened before. Yeah, okay, bankruptcy companies like Hertz, they may even demand a cash secured position upfront. Yeah, okay, now, so it all varies on the risk that the broker sees over here. Yeah, okay, it's all within their control. Yeah, okay, yes, Maureen, okay, great. That was good over here. Answer your question. Okay, all right, now, so I hope that addresses your question, Josephine. All right, yes, that's what they demand, but that's probably not the best deal that you can look at over here, right, to start the trade-off. Okay, right now, put spreads, same thing as well. We'll discuss this on Monday over here. All right, okay, now, but if you're within our community, right, you should be knowing how to structure this trade on your own. Okay, if you want to adopt the put spreads as a separate strategy on the same opportunity. Okay, all right. So make your own judgments over here, form your own, strategies. All right, and go ahead and execute it if you're comfortable with the stock that we have talked about. Okay. All right. Yes, Richard. Congratulations. Okay. Congratulations. All right. So your put spreads on the SPY should do pretty well right now. Okay. Leave a comment for us. Okay. Or let us know next Monday as well. All right. On how much it benefited you. Right. Or what kind of profits have you made over here? Just listening into one of our daily calls and our discussion over here. Okay. All right. So Richard, it'd be great if you can share, just by listening to our sessions over here, right? It even allows you to make some profits along the way. Okay, all right, now. Okay, so question by Beloved Tan, right? So Terence, if I sell the put options to collect the premiums, right, any percentage gains today or before 18 September, which is the expiry date, right, is surplus to the top of the premiums collected. All right, okay, or priced into the max profit. Okay, now, so I think to answer this question, remember, beloved, we said when you're a seller of options, okay, there is a maximum profit to the design of the trade. Okay, because if you're a store owner right now, okay, now, so let's say I open a supermarket, okay, now, and today a customer walks in and buys the mineral water, right, a bottle of mineral water for $1, right? To me as the store owner, right, that $1 that I take, the $1 that I get from my customer, it's perhaps already the maximum profit that I can make. Of course, I must less my cost of goods and everything like that. So in trading, we'll probably talk about commissions and stuff like that. Okay, but right, that is the maximum that I can make. So even if the stock goes up, right, I don't make anything more, right, because I don't own the stock, right? Okay. Now, so what I did was I sold a product, right, and right now, if the stock goes up, right, the claim on the product will probably be much less likely to happen right now. So what happens now is the opportunity of making a claim on such a policy that I sold is getting lesser and lesser, right, as the stock goes higher. Okay, now, so what you can do instead is this. Although you sold the 18 September expiry, it doesn't mean, right, that you have to hang on to the entire trade all the way to 18 September. Right? In fact, me and my community, right, did exactly the same trade on Berkshire Hathaway, right, at the last bottom, right, the one where you saw on the chart, right, somewhere in the middle of March. We did exactly the same thing over here that we're discussing today, right? Okay, now, so that means we have already made one round, right, as the market corrected upwards, right? And yesterday's opportunity or correction, or actually yesterday was a sell-off, right? Yesterday's sell-off presented us the second opportunity to repeat the same exact deal, right? Now, so you realize it can be actually done in a very simple manner. Right? Portfolio building doesn't have to be complicated. Right? So while I know that many trainers out there are probably better at generating bigger profits than I can, right? But I'm not, that's not my ballgame, right? That's not who I'm trying to attract. That's not, if that's you, that's not who I want, right, in my community over here. Right? Who I want in my community are normal day-to-day people, right, who lead their lives doing things that they enjoy, right? And they want the time to enjoy the things that they're doing. Right? But yet they know that they have to invest their money, right? Okay, and they're not happy with the bankers or putting their money in the bank, right? So this is the simplest way, right, that gives them the comfort knowing that safety is intact, right? But yet, right, creating returns, right, that can hit 30% and higher, doing these kind of safe strategies, right, that allows them the buffer of safety, right? Okay, and yet even if it's wrong, it can still be right. Okay, because they are all great stocks, right? And how do you execute it, right? And with practice, right, it gets better and better because you keep doing the same thing. Yeah. Okay. So if this is who you are, this is definitely who I want, right, to be helping over here. Okay. If this benefits you. Okay. All right. Now, so I think that's all the questions we have for today's session as well. Okay. So you realize I'm very detailed in today's sharing because this is definitely some of the strategies that I like doing a lot. Together with my students in my community, right? So yesterday's sell-off was pretty timely for today's session, I must say. Right? Okay, now, and let's see what the market has in store for all of us. Okay, we are seeing a rebound right now. Okay, but do not get caught into it. Okay, so do not buy into the rebound. Okay, because after such a correlated sell-off, what we may have is just a dead cat bounce, or technical traders call it as a corrected bounce. So be a little bit more patient, right? Let the market run for an hour or two, right, to see if the opening bullishness will fade. Okay, if it fades, then we'll probably see much more selling happening. Okay, all right. But if it rebounds and keeps going up, right, then you probably start to see the recovery of at least 50% of the losses that we seen yesterday. Yeah, okay, right. It is Friday after all, right? We probably have a lot of short-term traders who don't want to hang on to their positions, right? So if they short sold the market yesterday, right, they probably want to cover these positions before the market closed today in today's session. Okay, now, so Jin Hao over here, all right? So Jin Hao, students in my community, all right, Berkshire Hathaway, right? So Berkshire Hathaway is definitely one of the biggest stocks over here we talked about. So we don't do this often a lot, okay? And actually, interestingly enough, okay, I can't say this is for every stock, but we have sold put options on stocks that cost as little as $400, right, in margin requirements, right, and yet making sure that we will not face margin call issues, right? So it all depends on stocks over here, because you have BAC stocks that cost around about $20, right, and of course you have more expensive stocks like Berkshire Hathaway, which cost up to $170. Right, so different portfolios, different capitals, right, gets different stocks to play with over here. Yeah, okay, all right. Now, so our first opportunity, Pfizer, all right, if we sold, if I'm not wrong, the 35 put, all right, you could do that with as little as $700 deposit. Yeah, okay, and yet not being able to, yet you won't have to fear that you will face any margin calls if the sell-off continues. Yeah, okay. Right now, so Jinao, to answer your question, it doesn't take a lot, okay, but of course, investing still requires capital, and most of the brokers would like their account holders to start off with at least a minimum of $2,000. Okay, so to be an option seller, that's probably a start that you want to look at, right? And like I told most people I meet, investing is really a thing where you should operate in your own comfort zone. So whatever you have set aside for investment purposes, that is definitely the greatest start for you in your stage right now. Okay, so we have students who start from as little as 2,000 to students who have more than $500,000 to over $1 million in their account right now. So it all depends on where you are and which stage of life are you at right now. Okay, all right now. So thank you everyone for joining me in this session today, right? And thank you all for those of you who have shared the videos out there. If you have not done so, all right, and you like the 2 suggestions that I made, right, do make sure you click on the share button even after the session, so your friends may be able to pick it up after we have ended and follow up tonight, right, when they actually have their time to do so, right, at their own comforts, okay, and also catch up on such a great strategy and trade ideas as well. Okay, thank you very much. All right, thank you, Uncle Fu, as well. All right, I'm not sure you're going to execute any of these, all right, but you probably will. All right, Uncle Fu. All right, now, so thank you very much for joining me. I'll see you on Monday. All right, I'll see all of you on Monday for day, today is 13, 14. I'll see you on day 15, all right, next Monday at 9 p.m. Okay, all right, so we are back to 9 p.m. on Monday. All right, see all of you at 9 p.m. on Monday for Project Options Cashflow day 15. All right, thank you very much. Good night. This is I'm Possible Terrence Tan signing off. All right, and see all of you Monday. Bye-bye. Great, Uncle Fu. All right, you are ready in. All right, see you. Bye-bye, everyone.